I will tell you that having done this for a few decades, it's rarely the person that you expect to buy that ends up buying the company. And so you don't spend too much time trying to identify who the buyer is. You spend a fair amount of time trying to identify what gaps you're filling and what types of buyers there are.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Robert Antoniades with us. Robert is a co-founder and general partner at Information Venture Partners, a Canadian venture capital firm investing in fintech startups. In this episode, we talk about their investment thesis at Information Venture Partners, what they look for in companies while investing, how they add value to their portfolio companies, how they evaluate the exit potential of a startup, revenue growth versus profit maximization, and lots more. So without wasting any time, let's dive straight in. Hey Robert, so good to have you on the VC 10X podcast. How are you doing?
I'm very good today, Prashant. How about yourself?
I'm doing great as well. Pleasure to have you on the podcast. To start things off, can you first have your story and how you started investing?
Oh, my story goes back. I'm a financial services veteran. I joined my career in investment banking, equity capital markets, and so I've been through that part of the world. And as part of my um, growing or experience, I was doing merchant banking, which today would be called private equity and buyouts. And then in the mid '90s, when the internet started happening or started commercializing, not happening, people saw the value of becoming technology investors, and so I transitioned to becoming a VC and have been a VC since guess 1997. So it's been quite a few years, and so that's my history. I'm a financial services person, not an entrepreneur, who became a VC.
Yeah, that sounds very interesting. And can we learn about your investment thesis at Information Venture Partners?
Absolutely. So when Dave and I started Information Venture Partners, we focused on a thesis that was technology relevant to financial services. That's the basic concept of it. Most people would call us a fintech fund, and I think that is accurate. We are a fintech investor, but we look at technologies more broader than that. So if it's relevant to a bank, an insurance company, an asset manager, wealth manager, capital markets organization, we're interested. So our thesis is tapping into the IT budgets of financial institutions, and so we're looking for technologies that solve problems within those financial institutions, and we can categorize them because I think they're relatively straightforward. So the first, for example, is modernize. Financial institutions need to modernize, so they're always looking for, generally speaking, fintech specific technologies or SaaS, enterprise SaaS. So enterprise SaaS could be the difference being that enterprise SaaS sells to organizations broader and more than just financial institutions. And in our definition, fintech sells exclusively into financial institutions. But another theme is protect. So protecting the data, the customers, the reputations of financial institutions. So there's a lot of cybersecurity investing in there. Embed is another theme of our fund. Embedding is really about providing financial services through non-financial institutions. So the infrastructure that allows organizations to do that. And I think the last theme that we have is steer. And steer means providing technologies to the function of finance. So this is where we're slightly different. So we look at technologies that are there to modernize finance, to make CFOs and finance strategic partners to the business. And so slightly different than the previous three because it doesn't necessarily mean only into financial institutions, but nonetheless still aligned with our general thesis. So that's how we categorize ourselves: technology for finance, for financial institutions and finance, as opposed to purely a fintech play.
Yeah, that's very interesting. And so you're investing mostly in fintech companies, and they can, get into enterprise SaaS as well, like a more broader theme than just fintech, right? So how are you evaluating these companies? Like if a deal comes to you, then on what basis are you evaluating them to see if it's a fit for investment or not?
The first thing we consider is the actual problem statement. What is the company solving? What problem are they solving, and how does that fit our thesis? And one of the things that makes us different is that we have 5 of Canada's 7 largest banks as limited partners. We also have some insurance companies, And so we have very unique insight into the operations of financial institutions and the problems that they face, their prioritizations, how they're spending their budgets, who's doing the buying, et cetera, et cetera. And as you know, with SVB of a couple of months ago, themes within financial institutions change all the time. So having that kind of direct contact and access to organizations like that, I think makes us a better investor and a better partner to entrepreneurs. But the fundamental question we're always trying to answer is, what problem are you solving? Is that problem pervasive? Is it common? Is it a problem for today, or is it a problem from 5 years from now? And then ultimately, does the technology work, and is it the right technology to solve the problem at this time? But without having a clear-cut answer to the problem statement, we would probably struggle a little bit as an investor.
Yeah, that's a great approach. And how do you assess this scalability factor in these fintech startups? Does like the competitors play a role? Does total market size play a role? And what are like the one theme of startups that you personally like the most because of the incredible opportunity that there is?
Yeah, all of those things make a difference, and I make a difference. And I would add many, many other things like management teams. That's an important thing. Global um, exposure or global opportunity is another one. Financial institutions, as you know, are regulated by region, and certain regions have certain problems and others don't. Certain areas in the world have different prioritizations, and so we like to invest in companies that have a global mandate and a global view of the world. So those things are all important. Um, and so when we evaluate them, um, for us, it's the combination of all of those things. Tam, you mentioned competition. You mentioned differentiation. I think you mentioned differentiation is more than intellectual property. It's know-how. It's go-to-market. It's a lot of different things. And so we like those the companies that have kind of a full package. How we determine whether or not the opportunity is scalable is interesting, because we invest very early stage. Very early stage to us means a few 100,000 in revenue. Sometimes they have a couple of million in revenue. And so what we try to do is stitch together that thesis based on the customer feedback that we get, alongside the input that we get from our networks, including our limited partners, and trying to stitch together that investment thesis that says, hey, here's that total opportunity that we have to address your TAM. Here's the competitive landscape. We often get information and intelligence on who else is in the market through our calls with customers and prospects in our networks. So it always helps us kind of build and extrapolate that investment thesis, and that's, I think, what we do well. To identify a few companies that I think are interesting in our portfolio, which I think you asked about here, Prashant. I would say Big ID is a very interesting company. It's all about PII, personally identifiable information, or it was, and it's about general data monitoring and risk control and risk management, understanding what data is where and how to control it and how to protect it. In our steer thesis, we have a company called Procurify, which is all about spend management, procurement management. I think it's a very fascinating company from the very simple perspective that everybody attacks this problem as an after the fact problem. Prashant, I've been in many board meetings where we've overspent and we only find out after the fact. Well, what Procurify does is allows a finance organization to prevent spend from happening. And it has that mid-market opportunity, which is below Coupa and above some of the competitors. And I think it's a very, very exciting company. I would probably point to, in today's world, another company in our portfolio, Empyrean. Empyrean is an asset liability management application for banks. We saw the challenges that we had with SVB, and the challenges with SVB were really about asset matching. They had long dated assets in a short dated world. And this is what ALM allows you to do. It allows you to match. It's fundamental to any financial institution, any bank. And what they've done is they've actually evolved to provide, because this is a key feeder feeding data to a budgeting and planning applications. They've now built the budgeting and planning application. So it's a very unique company, and banks love it. And we've got many banks as customers, from credit unions and regional banks to larger super regional. It's a problem that's pervasive in the industry. Um, and on that same theme of budgeting and planning, we've got a company called Giraffe, which is tackling the mid market and lower mid end of the mid market for that. It does reporting, obviously budgeting, planning, dashboarding, and what's unique about it is, first of all, it's the best product on the market, and all the reviewers will tell you about that. But we also have a partnership with CPA.com that allows us to partner with CPA firms around the country. To us, that's very valuable because we get direct feedback from the practitioners. They like the product and they introduce it to their customers. So we've got a broad set of companies. All of them are unique. All of them are special. Uh, you know, so we're quite happy with the portfolio that we've built, Prashant. Sorry, that might have been a long answer, but
Yeah, no worries at all. Yeah, that's great. Like, those are some really interesting startups in your portfolio that you just mentioned there. And let's talk about the challenges that startups typically face when they're operating in the fintech ecosystem.
the biggest one is if you're in enterprise, it's the sales cycle. Selling into a JP Morgan, a Citi, RBC, UBS, whatever it is, whichever bank you choose, if you're in the top 200 banks in the world, the sales process is agonizingly long and difficult. It is complex. It is a true enterprise sale. If you can get it done in 12 months, you're lucky, but you're probably looking at 18 to 24 months, which makes planning very difficult, makes kind of capital allocation to each opportunity difficult, and pipeline generation is super important. So we often work with our portfolio companies to kind of create two tiers. One is uh, credit union and community banks, which have much smaller and easier sales cycles, and then also large regional and super regional banks, and selling into those, which is more difficult. So sales cycle, very difficult. Credibility. No financial institution, Prashant, that you know of or ever want to be a customer of wants to risk your data, wants to risk your money. And so kind of they put all of our companies through a torturous due diligence cycle, whether it's security, whether it's scalability, functionality, usability. It's all there. So I think that's another difficult aspect of selling into the market that we sell into. And I think I would say the following is an important one. It's not the most difficult one, but it's an important one. Budgets change all the time. So the good news is IT spending in financial institutions isn't shrinking. It's almost always growing at the rate of inflation or better, and in many cases, much better. And so we've seen a big swing in IT spend by FIs over the last 20 years as a proportion of their overall spend. But the priorities change. And we saw with SVB very quickly, I think the way a bank was thinking about risk changed overnight. And so there's now dollars being moved from one apparently lesser priority to one greater priority. So you always have to manage kind of the budgets of these organizations, or understand the budgets of these organizations. And so I think another challenge that all of our portfolio companies face.
Yeah, absolutely. And that is an important aspect about long sales cycles, especially when it takes as long as 12 months, right? That's very long. And like, initially, you're investing in early stage startups, right? And credibility, how do you build credibility as a startup at that stage?
The first and foremost is by talking their language. So many of our founders, entrepreneurs, and CEOs actually come from the industry, and they've lived the problems that they're trying to solve, and that's very different than on the consumer-facing side of fintech. You can get young, ambitious entrepreneurs out of college who, you know, have a problem that they can't send money to their friends, or they can't split a bill, or whatever it is. That's very different than speaking the language of the financial institutions. So that's the first and foremost. And even if you don't have that experience, surround yourself with a team that does, advisors or a board that does. I think that's the most important thing, because nobody wants to lose their jobs buying your technology. And so you really have to be well versed in what is going on in your customers, in your ICP.
Right, certainly that's true. And while you're investing in these startups, like how are you balancing, uh, you know, uh, the revenue growth and the profitability factor, especially in today's market when like everyone wants profitability, wants to see money flowing in. So how are you balancing those two aspects, the revenue growth aspect and the profit aspect?
Well, it's Prashant. That's I guess at the end of the day, that's the magic question for all VCs. Obviously, we want revenue growth. We want healthy revenue growth. Understand that in financial services, you sign one customer, then you might sign two, then you might sign three. It's not exponential. It's very rarely exponential. And so if you understand that, then you can probably put together an appropriate cost structure for an organization. My view is grow as fast as you can while maintaining control of the business. And so even in difficult situations or difficult times like we're in today, understanding what capital you have available to you with what milestones is really important. Because if you understand that, then you can work backwards and say, this is how much we have to play with, and this is our buffer to ensure that we get to those milestones. As you know, Prashant, valuations are way down. Raising money is much more difficult. And so we would be approaching it differently than we would have pre-COVID. I think pre-COVID, there would have been more aggressive growth expectations. Today, we're looking for reasonable growth expectations while maintaining control. In other words, don't run out of money. And if that means you've got metrics that allow you to kind of retrench internally and become profitable when you need to, that's terrific. Otherwise, you make sure you're hitting the milestones that allow you to raise additional capital at fair and reasonable valuations.
Right, absolutely. And what's your recommended runway for startups, especially in these times? And how early should they be starting to raise their next round of capital? Is it like 6 months, 12 months? What's that number according to you?
I don't think you should expect to raise money in less than 6 months. That doesn't mean companies can't do it, but you should at least give yourself 6 months. So if you're giving yourself at least 6 months with buffer, you should be in market at least 9 months prior. I would tell you be 12 months prior. And I always view and that 12-month mark is really important, because I view that as being in control or out of control of your business. So if you have capital, enough capital for 12 months, you generally have optionality. If you start doing it too late, if you start trying to raise money too late, making cuts too late, at the 6 month mark, you don't have optionality. Then you become a price taker from anybody who provides you capital. If anybody provides you capital, because VCs are smart, they'll wait you out to get an even lower valuation. So again, this is about being in control and understanding where you are. Um, and so I would advocate get into market closer to the 12-month mark before you need the capital than the 6 month mark.
Absolutely, yeah, that's a sensible thing to do. And let's talk about value add. So, how are you helping your portfolio company? You said that you have some LPs who are these like institutional banks, like biggest institutional banks in Canada. So, are you like making those introductions to your portfolio companies, or in what other ways are you like trying to help your startups?
Absolutely. I mean, they're part of our differentiation, and we do make those introductions. Obviously, we can't control what those institutions do and who they buy from, but we also use them for kind of product strategizing. If our companies want to think about new functionality, new products, we can introduce them to the right people within those organizations. But I think our most basic form of value add is being a trusted and transparent partner. We view ourselves not just as investors but builders. And builders here doesn't mean running companies. That's not what we mean. That's the management's role. What we mean is being there to help them build the companies in any way, shape, or form that is necessary. Trusted and transparent partner is critical to that. Making the networks available to the is critical. Asking the difficult questions is critical to that. Making them better people and better executives and managers is critical to that. And so over the last 25 years of doing this, we have found that that's the best way to win, is to be a partner in the building process, not an investor that is passive, not an operator that is intrusive. It's about being there's a balance there. It's and it seems to work with our CEOs.
Yeah, certainly. And let's talk about the exit potential of these companies that you're investing in. So how are you thinking about the exit strategy? So while you're investing, are you at that point, is it in your mind that, okay, how am I going to exit this company if I invest in this? Or is that a thought that you give later in the process when you're already invested 2 to 3 years, and then maybe you start thinking about that aspect? And what's the typical return expectations for a fintech company?
Okay, so to answer your questions here, yes, it is something that we think about at the outset. So we think about possible acquirers. We think about so that not only companies but types of acquirers. Obviously, PE is always a potential acquirer. An IPO is always a potential exit. But we really think about kind of where they play in the ecosystem and who's most suited for them. Um, I will tell you that having done this for a few decades, it's rarely the person that you expect to buy that ends up buying the company. And so you don't spend too much time trying to identify who the buyer is. You spend a fair amount of time trying to identify what gaps you're filling and what types of buyers there are. As we progress through the development of the company, in your case, you asked about 2 or 3 years in. I don't know when we start thinking about it, but we start thinking about um, more specifically who we should be partnering with because we fill a specific gap for them. And that is often a way an acquisition is done. So we start kind of becoming a little more thoughtful about the ecosystem and how we need to manage it and how we need to what role we need to play in it. And so that's kind of our active management of an exit. We don't, as a firm, have a corporate development team that helps sell companies. That's not we're way too small for that. We have a lot of friends in the investment banking community who could help us there. So that's not a role that we play. In terms of returns, uh, Prashant, we go back and forth between IRR and return on capital. How many turns on capital? Our expectation is if we can make 5 times our capital over a 5 to 7 year period, even and 10 times our capital over a 10 year period, we would be happy. I think every LP would look at that and say, "You guys have done exactly what you should be doing," and they would be very happy to reinvest.
Yeah, absolutely. You've been investing in startups for quite some time now, right? So, what's been your biggest learning while investing in startup over the years? What's something that you've learned now that you wish that you had learned earlier in this investing journey?
Oh, there's a lot of lessons. First of all, is be patient. Great companies take a while to build. And you got to find you got to build your foundation, get a solid footing, and then you have to grow, and you have to grow your team, you have to grow your product suite, you have to grow your go to markets. There's a lot of building that needs to happen. You got to get pricing right. You got to get your partners, your board, and co-investors right. A lot of things that have to happen in order for you to be successful. So be patient. That doesn't always happen overnight. The second thing is that it's hard work. Um, Again, we're not passive investors. We're active investors, but non-intrusive investors. And so we get involved in many decisions or help companies make many decisions. And that's difficult. Um, and sometimes we have to have difficult conversations with founders and entrepreneurs. That's hard work. But that's our job. That's our responsibility. Um, and that and so that's another learning that this isn't easy. If you've gotten into VC because you think this is easy or every company turns into a unicorn, I think you're mistaken. Venture capital is very difficult, but it's thoroughly enjoyable because every day is different, every company is different, and so you get a sense of accomplishment when you look back after 5 or 10 years and say, "Hey, I was involved with that company or this company, and this is where it's at today, and this is who we sold it to, or it went public." Whatever it might be, it's very gratifying to look back. Um, and the other thing I would say is uh, be prepared. So I think we've gone 10, 12 years since the last downturn in venture, and there's plenty of GPs and VCs out there who've never been through a downturn. I think when we saw COVID hit, we prepared our portfolio companies for what we thought were going to be very difficult times. Um, Prashant, another learning is we can be wrong, and in that case, we were wrong. I mean, we the next 18 months in tech investing were the best 18 months in 2 decades, uh, but our portfolio companies were prepared, and so we felt comfortable that whatever happened, we would be we would be well positioned to survive whatever happened. So being prepared, and that's our job. That's our job, and it's our job to make all our portfolio companies, CEOs, and companies prepared as well.
Yeah, absolutely. Yeah, those are some great learnings out there. It will be really very beneficial for like emerging managers out there just starting out in this journey and navigating the waters, right? Now let's move on to our last section for this episode, which is the rapid fire round, wherein I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Sounds good.
Perfect. Let's go.
All right. The first one goes: what are the sectors and regions you invest in?
North America technology for financial services.
What's the typical stage of investment?
Early revenue, few $100,000 of revenue, say 500,000 to a couple of million.
Right. And what's the typical check size you put in?
On average, about 4 million US for our first check. So could be as low as two, could be as high as 6 or 7.
All right. And where can founders apply for funding in case there is a direct way?
Uh, info at informationvp.com is the email address that you can send things to, or find out a way to get introduced to us indirectly. It's always better to find somebody in our network who can introduce you to us rather than coming to us blind.
Absolutely. And where can our listeners follow you?
Uh, well, we're at hashtag information VP. I'm not a big Twitter user, but I'm rant on um, rant on VC, and ultimately you can also come to, I guess, our website at informationvp.com.
Absolutely. I'll make sure to put all those links in the show notes below. Thanks so much for coming on, Robert. It was a pleasure hosting you on the podcast and like getting all these learnings from you on investing in fintech. Thank you so much and happy investing.
Prashant, thank you for having me. Hope to speak to you soon.
Absolutely. Thank you.